afternoon, ladies and gentlemen. So I'm here today to really talk to you about Henderson High Income Trust, a trust that I've been managing since 2012. It's grown to about 380 million of gross assets. And I intend to answer 4 questions for you. So the why. Why should you consider an investment trust like Henderson High Income? Then I'll answer the how we do it, how we manage the assets, how do we generate that income. Then I'll talk about who are we? You know, I'm just a man standing in front of you, but who's the team behind me, etc. And then the why now. Why would you consider it now? And I'll go through those points. So why? Hopefully no one's done this joke today, but I dub it the Romson of investment trusts. And hopefully looking at the age demographic of this year, of this audience, hopefully you understand that joke. It does exactly what the name suggests. And that's to provide that high level of income, but also the prospect of capital growth in the longer term. You can see that on the chart on the left-hand side there. So, you know, we currently yield 6.2%, which is obviously clearly more than what you can get in the UK market. It's more than you can get in a deposit rate currently, and it's more than you can get from a 10-year government bond as well. So we deliver that big income. We also deliver dividend growth as well. So since I've been on the trust, we've grown the dividend every year for the last 12 years at a compound average growth rate of just over 2% there. So we deliver a high income, but also dividend growth as well. Now that's all very well. What does that mean for you as shareholders? So similar to the previous presentation, what's happened to a £10,000 investment back in 2012 when I came on the trust? What have we delivered for those shareholders? In terms of income, £10,000 has paid you back £12,300 in income. Again, that's significantly more than you could have got as income for an investment in the UK market. It's obviously hugely more than what you could have earned just in a savings account. Now, we have obviously been through a period of low interest rates, but even though interest rates are higher, we're still yielding, you know, yield premium to a deposit account. Also, over those 12 years, you've also delivered capital growth. So that £10,000 initial investment would be worth £14,500 today. So delivered income, also delivered capital as well. So that's for people who want their income. For those that don't need income today and are happy to reinvest those dividends back into the investment trust, this is what you could have got. This is the return you could have got. We call it total returns. So that £10,000 investment would have turned into over £30,000. Again, that's beaten the total return of the UK market, it's beaten the total return of cash as well. So that was very much why I consider it, very much an income product, but does offer growth at the same time. So how do we do it? How do we do it? So we are very much a UK equity trust, but the one thing that differentiates us is our ability to own bonds. So you should consider the split of our assets, 80% typically in UK equities, 20% in bonds. So each one bring their own components. So UK equities, invested in UK listed global companies, they pay dividends. They also provide dividend growth as well. You know, over the long term, companies grow their profits and likewise will grow their dividends at the same time as well. It also provides you capital growth. So we're investing in companies that we hope their share prices can go higher in the very long term. So that's what the equities bring. In terms of the bonds, slightly different. It provides coupon income. So effectively, we're lending to a company and they're paying an interest rate. That's fixed, provides you a bit of good visibility over that income. It also provides more resilience. So in downturns, companies are more likely to pay their bondholders ahead of their equity holders. So it gives you that resilience in tougher times as well. And also, typically, bonds are a lot less volatile than equities. So it helps dampen the overall volatility of the trust as well. Now, one thing you should know is to invest in the bond portfolio, we utilise gearing. So one of the key advantages of an investment trust over other investment funds is our ability to utilise gearing to help enhance returns. So how we do it is we use it to enhance our income. So going back to our original example of that £10,000 investment, now I can take that £10,000, invest in UK equities yielding 5%, and that gives me an income of £500. I then go away myself, go to the bank, borrow £2,000 and invest that in bond assets, yielding 6%. That gives me an extra £120. Now, of course, I have to pay interest to the bank, say at 3%. But my total income is the £500 I get from the equity portfolio, £120 I get from the bond portfolio, and then I pay out £60 back to the bank in terms of my interest charge. But essentially, from that £10,000 initial investment, I've boosted my income from £500 to £560. And that's effectively what we do at Henderson High Income. We're able to borrow cheaply, invest in a bond portfolio to help boost the overall dividend for the trust. So what do we look for in companies? So what's my day job? What do I like about companies? So I always ask myself 3 questions. Firstly, what are a company's key attributes? Do I understand the company? Do I understand what it does? Do I understand how it derives its profits? We're looking for good quality companies that can survive, that can grow, that are going to be around in 10 years' time. You know, what are their barriers to entry? What's their competitive advantage? Can it be competed away? These are the things we're asking ourselves on a daily basis for the companies that we invest in. Then we ask the question, is it financially strong? Now, what are we looking for? Well, we're an income fund manager, so company's got to be able to generate cash, because essentially the cash pays a dividend. But we don't want companies that just pay out all their cash flows to dividends. We want to make sure the companies are invested appropriately in the businesses to make sure they can grow in the longer term, because essentially we want that dividend today, but we want a higher dividend into the future. So how good is the cash flow? Also balance sheet, very, very important for us. You know, companies need to have strong balance sheets because, again, we can't always predict the future. And a company needs a strong balance sheet so when times are tough, they can survive. They can carry on paying that dividend, even if profits come under pressure, because they've got strength of that balance sheet. So those are 2 key metrics for us. And then lastly, what's the company worth? You know, it's all very well finding a good quality company that's in very strong financial health. But if it's expensive, if the share price is high versus its profits it generates, then your capital return is more limited. It's about finding those good quality companies that are in strong financial health, where you believe the market is undervaluing it versus what you think the company is worth. So it's about combining all of that. And at the end of the day, we want to own companies that can pay and grow their dividends into the longer term that we believe are undervalued. So talking about a specific example, so one I bought late last year is Reckitt Benckiser. So why do we like the company? Look at the key attributes of it. So this is a company that owns popular brands, Nurofen, Strepsil, Gaviscon, Dettol, Vanish, you know, very much household names. And we like that. Strong brands, number 1 and number 2 in key categories, they are go-to brands. If you're ill, got a headache, I don't care. Just give me Nurofen. I need it right now. You know, these are go-to, and that's popular. That gives it the stability. Means that supermarkets are happy to list their products on their shelves. So that's what we like about it. Gives it good strength, gives it stability through a cycle as well. You know, these are everyday items that people don't necessarily scrimp when times are hard. They still go out and buy them. So that's why we like it on the fundamentals. So what about, is it financially strong? Well, it generates a lot of cash. After it's invested in its own business, it generates $2 billion a year of cash. Basically, it converts 100% of its profits into cash that it can distribute to shareholders through dividends. It's also got a very strong balance sheet as well. That's what we like. Again, strong balance sheets just in case. And then what about valuation? So today it trades on 14 times PE, so price relative to its profits it generates. That's versus 18 times over the longer term. Over the last 20 years, it's traded 18 times. The lower the PE, the cheaper it is. So at the moment, it's discount to where it's traded historically. And it also pays an attractive dividend yield, 4.1%. So good for us and provides that dividend growth. Now, we were quite opportunistic. We've known the company for years, but we haven't invested in it. It's only recently it's got into a bit of trouble, so the share price has come down, but we did a lot of work around it. We met the management team, we modelled out different scenarios about where we think their profits can go, and we got comfort. It's not about making a decision at the spur of the moment. It's about going away, doing proper work over the weeks, maybe months, getting comfort on it, meeting management, as I said, and then investing in the business. And I also like to have good diversification across the portfolio. It's not about putting all your eggs in one basket. And these are the three types of businesses I like to own. So stable growth businesses, like I said, Reckitt Benckiser, consumer staple, stability, gives you certainty of dividend growth over the very long term, irrespective of macroeconomic conditions. The next one is more cyclical companies, what I like to call quality cyclicals, good businesses, good strong financials. So Next, the retailer, it's been a very difficult market for clothing retailer in the UK, but Next has grown their profits year in, year out despite that tough market, despite the proliferation of online shopping. They were at the forefront of that. They've been able to grow their business. And that's the type of company, that's the type of cyclical company. Yes, retail has its moments in tough moments. But a company like Next, well managed, great capital allocators, can still drive their profits through that to generate good share price returns. And then lastly, the high yielders, the big stable businesses. National Grid owns a lot of energy infrastructure across the UK, regulated, so we've got good visibility about the profits they're allowed to make that's defined by the government and the regulator. So again, pays a nice healthy yield for us, and we've got good stability, good visibility over that yield. So blending all those types of three businesses together to generate a good growing income that we can then distribute to our shareholders. So the who am I? David Smith, work for Janus Henderson. We are a global asset manager with strong UK heritage. So the name Henderson, who you would have met, one of the grandchildren earlier today, presented for Lord Adventure. Our heritage goes back 90 years in the UK. We've now grown to over 2,000 employees worldwide. I sit in London. I've got a team, 12 people around me, all focusing on income. Very much income specialty, very much in investment trusts. So strong income heritage. It's a good business. I've been there 23 years, so it can't be too bad. Why now? Why should you consider an investment in UK market? Well, these are two charts. First one on the left just looks at what's known as the UK Economic Surprise Indicator. And it takes various different economic data and analyses it. When it's above zero, it's positive. We're surprising on the upside. If it's below zero, it's surprising negatively. Actually, we're starting to surprise on the upside. Actually, things may not be as bad as we all think, or as we're led to believe in the media. Things are slowly improving. If you look at the chart on the left-hand side there, just shows you where some of our costs are going. Firstly, the black line is the crude oil price. It's actually, oil is falling, that should flow through into cheaper prices at the pump, lower energy bills, etc. The turquoise line is a 2-year swap rate, which is effectively mortgage rates. That's what banks price their mortgages off. Slowly becoming down. So actually mortgages are getting cheaper. And you start to see that come through in better house building volumes early in the year. Now, I'm not describing it's going to be boom time in the UK, but I think it's going to be slightly better than maybe people think, and certainly what's priced into markets. And here you can see, we talk about valuations of stocks. When you look at the valuation of the UK market as a whole, again, at 11.8, we're below that long-term, that 20-year average of 12.5 times. And when you look at the table at the below that, we're very much cheap versus all those other global indices as well. So the UK is very much out of favour. And what's quite interesting actually, since interest rates started going up in December 2021, the FTSE 100 has actually outperformed the MSCI World ex-UK index. So actually, that narrative of the UK always underperform is not necessarily true, especially in the last 3.5 years where it started doing better when interest rates started going up. And what's great about it, we've had a strong performance, but still a cheap market. There could be more to go for it. Now, most people presenting today probably talked about discounts, etc. We're not alone in that. We also trade at a discount. Now, historically, only a couple of years ago, we were trading very close to par value. We're now trading at a discount. Again, I think that's the opportunity. We invest in readily marketable listed securities that we know the value of. And yet, despite that, we're trading at a 6% discount to the value of those assets that we know. So I think that's an opportunity. And then performance-wise, I've talked about it before. We've delivered good performance for shareholders as well. So, just to sum up, answering those 4 questions. So the why. Well, we deliver high and growing income stream to shareholders, but also the prospects of capital growth. How do we do that? We do it through a unique structure of investing both in UK equities, but also bonds. And that's where we utilise a gearing. That's our unique feature that no other UK equity fund does. That's how we get that high income. We're a highly experienced income team in a large global asset manager, and we run a lot of investment trusts. We understand investment trusts. And finally, why now? The UK market, we believe, is undervalued and unloved, and that can change. But thank you very much for the time.